Let's jump right in. This week, August 2nd through the 8th, 2026, we are tracking an absolutely massive volume of disclosed capital transactions. And I'll tell you right now, we're looking at a market in motion, but it is definitely not chaotic. What we're seeing is highly deliberate, and that's exactly what we're going to break down today. We're talking over $2.35 billion in disclosed capital deployed this week alone. But honestly, what's striking here isn't just the sheer size of that number. It's the pattern. This deployment is a remarkably clean expression of single, hyper-focused strategic motives. We're seeing major players move from minority stakes to full ownership, or watching specialty players exit non-core retail to double down on reinsurance. And on the venture capital side, we're seeing them actively value AI-native consumer brands over invisible infrastructure. The main theme here: total strategic clarity. So here's our roadmap for today. We'll quickly cover American Family's buyout play, the Asian bank assurance consolidation, Everest shutting its retail operations, Faye's rejection of embedded insurance, and finally, we'll wrap up with a couple of key tech and prevention acquisitions. Okay, let's start with Section 1, American Family's founding to buyout play of Bowhead Specialty. American Family is putting up $1.2 billion to execute what is essentially a perfect founding to buyout template, because they actually helped found the company and have held a 14.3% minority stake since Bowhead's 2024 IPO. They've been able to sit back and watch the underwriting discipline compound from the inside. And because of that insider position, they only had to pay a very modest 11% premium, completely avoiding the crazy markups of a blind auction. Basically, they knew exactly what they were buying. Bowhead's chairman, Matthew Batain, hit the nail on the head here, calling it the natural evolution of a long-standing relationship. And just look at what American Family is actually getting out of this deal. They are securing a specialty platform that just reported 28.2% premium growth and a 13.8% return on equity in Q2 of 2026. Plus, founder Stephen Sills remains on as CEO. That means American Family acquires this high-performing specialty commercial lines exposure with virtually zero execution risk. It really is a masterclass in capital deployment. Moving on to Section 2, let's look at bank assurance consolidation in Asia, specifically featuring Ageas and Maybank. Ageas is selling its roughly 31% stake in the Atika joint venture to Maybank for 1.1 billion euros. To put that into perspective, Ageas secured a 2x price-to-book multiple. That translates to an estimated net capital gain of 450 million euros. They are incredibly efficiently capturing 25 years of joint venture value creation all in one single transaction. Now, why is Maybank paying this premium? Well, there's a massive structural shift underway right now. Banks across Southeast Asia are aggressively consolidating full control of their bank assurance channels. With regulatory tailwinds heavily favoring bank-led distribution scale, Maybank clearly views 100% ownership of Malaysia's leading platform as an absolute strategic imperative. They want the whole shebang. Right, let's pivot to Section 3, Everest shutting retail drag through the Mexico sale. Everest Group is officially selling its Mexico insurance operations to Fairfax. And this deal is actually the final, highly deliberate step in a multi-year retail divestiture sequence that they first announced way back in October 2025. You might remember the timeline. First, they sold Colombia to AIG. Then, they sold Canada to Wawanesa. And now, the final piece of the puzzle, Mexico goes to Fairfax. The driving motive here is absolute focus. Everest is actively ripping retail commercial lines out of its portfolio, specifically in markets where it just doesn't have the scale to dominate. By shedding this retail drag, they're freeing up their capital to double down entirely on their core high-return businesses, which are their reinsurance and global specialty franchises. They are literally telling the market, loud and clear, exactly what kind of underwriter they intend to be moving forward. Let's look at the venture side in Section 4. Faye rejects embedded insurance with a massive $50 million Series C raise. Faye's valuation has absolutely skyrocketed to roughly $500 million. That is a 10 times jump from its 2024 Series A valuation. Now, in a market that is heavily punishing those old growth at all costs models, you have to ask, why is Faye commanding these massive premiums? Well, it's because they are making a very specific strategic wager against standard industry consensus. Specifically, Faye is explicitly rejecting the embedded insurance model. We've seen competitors like CoverGenius build massive valuations by being that invisible infrastructure layer, the one hidden right behind a checkout button. while Fay is doing the exact opposite. They are building a highly branded, consumer-facing app. Their bet is that owning the end-to-end relationship with the traveler, before, during, and after a trip, is ultimately going to be way more valuable than just being an invisible, commoditized line item. But here's the catch. That direct-to-consumer model requires extreme operational efficiency to actually be economically viable. And Fay is targeting resolving over 50% of all claims completely autonomously by year-end 2026. On top of that, they want 75% of their remaining claims to close on the very first touch. This AI-driven claim speed is the exact proof point that justifies the heavy cost of maintaining a direct consumer relationship.
Okay, bringing it home with Section 5, acquiring tech and prevention through special situations.
We're looking at two rapid-fire moves here where carriers are buying operational speed rather than trying to build it in-house. First, we have AXN XL. They just converted a 15-year minority stake into full ownership of SRM, which is a global cyber intelligence consultancy. So they aren't just buying a vendor here. They're actually building out a dedicated pre-loss risk advisory unit to compete directly with broker-side consulting arms. Then, in a similar vein, Federated Insurance quietly absorbed HDBI, a venture-backed AI-native commercial auto MGA. So instead of trying to build their own trucking telematics capabilities from scratch, they simply bought the AI-native platform outright. Both of these deals show us exactly how legacy carriers are willing to pay up for immediate, advanced operational capabilities. So let's synthesize everything we've looked at this week. What we are witnessing across the board is a dramatic narrowing of the lens. Every single transaction we've examined today reflects an extreme level of strategic focus. You have large players like American Family and Maybank paying strict premiums just to secure absolute control of proven platforms. You have specialty players like Everest aggressively shutting peripheral distractions so they can concentrate their capital on core returns. And you have venture capital backing very specific operational speed via AI, just like we saw with Fay. Across all tiers of the market right now, from the mutuals to the global reinsurers, all the way down to venture-backed startups, there's absolutely zero tolerance for strategic ambiguity. The capital is precise this week. Which leaves us with this final critical thought. Take a hard look at your own balance sheet and your own strategic roadmap. As the market's capital rapidly narrows its lens, where is your organization risking distraction instead of paying for precision? It's definitely something to think about. Thanks so much for joining this explainer, and we will catch you next time.